We talked about the equity markets a little bit, and I agree with what David said here. There's a significant amount of equity on the sidelines for all investments. They're having a hard time, finding the yields that they were hoping to get. They've readjusted their expectations, and they will deploy this money that they've been sitting on and not investing, because I don't think they really want to give it back to the investors. On the other hand, some of these investors are nicely asking for that money back, and I think that most of the equity players that want to stay in business long term are probably going to give that money back if they're asking for it. We also spoke about this. I think this was Drew talked about the spreads, narrowing. And if you take a look at where they were at 2008 versus where they are today, this is in large part has to do with why money is more available today, and you can make deals make sense. Is when you're borrowing at 3.5% versus 7.5%. You can afford to pay a lot more for an asset, and when you can borrow at 75% leverage as opposed to 50% leverage, the numbers just work. And they work much better than where they did, but they still don't work when you have value that is not exceeding the debt. This shows that CBS market that I was talking about before. It's getting a little bit better, but we've got a long way to go here, and it's. I'm not sure we're going to get to 2004 numbers anytime soon. So who's going to fill that void? If you take a look at how much that was on a permanent, this was all 5, 10-year fixed rate, non-recourse loans, which is what everyone with the bank wants to get into. And as I said before, the life companies are the second best lender, and they're going to put out $40 billion a year. This just talks about transaction business being down 90% from the peak, and that was in 2009. It's going to be it's probably double this year. It's actually great, but it's we're still down 80%. Cap rates are clearly a function of interest rates. They lag. I think that cap rates will continue to go down a little bit on the best product. You have the institutional money doesn't mind buying assets at a 5%, even sub 5% yields, so long as it's relatively low risk, given the alternative investments right now. I think some of the indices in the market that are showing what values are probably delayed by 6 months. Everything's lagging right now. It's actually a very attractive market to try to sell into if you have an asset that doesn't exceed the debt, and it's a core type asset. For everything else, it's still a little bit problematic. This is talking about the bank charge-offs. The banks weren't, I think, in large part, did not want to write off as much of the real estate loans as maybe they could have if you wanted to kind of mark to market it at some point in time when values were down 35% across the board. That would have been interesting. I think it would have been had a devastating effect. I think the banks have been making a lot of money over the last couple of years, or especially the last year. I think substantially over where they were last year, and so I think they're able to afford to take some of the write-offs on some of these problem loans. And I think once they do that, they'll start selling these assets into the marketplace finally, which will allow for some of this equity money that's been sitting on the sidelines waiting for the opportunities to kind of take advantage of assets that at least they feel like they're going to make a deal. I'm not even going to talk about the banks. I'm going to let you talk about the banks here. There's the takeaways. There's lots of capital. It tends to be for certain type of product. It's kind of a tale of two cities right now. The fundamentals are, they actually declined in the second quarter. We need to at least stabilize that. The good news is values and everything's looking good in light of the fact that you have declining fundamentals. And why? Because interest rates are down, and that's counterbalanced it. You have increasing values that have resulted from this low capital, and clearly the debt restructuring has to continue. Whether people like it or not, it's going to be kind of kicking the cans down the road a little bit. I hate that term, but that's kind of what it is. And I do think the banks will begin to sell more notes. It's going to be the product and with the sponsors that they don't look as favorably upon, and they'll sell it on a home loan basis. And I think they'll probably sell it continually, as we've been seeing through this live, either live auction or kind of eBay type auctions. Thank you.